Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Greetings, everyone. Welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht in a very nice blazer from Canada. Yes, the other coast. I am very glad that you joined us so we can talk a little macro. Definitely, there's a lot going on here, but we've got some quant to dig into as well, not just technical and macro and sentiment. Lots and lots of macro moving headlines, of course, but we're looking for a bounce. I would say more than that. We're actually looking for a bounce instead of a trounce because we are still very much on pivotal support that could very easily give sway. And we're hoping that we get some consolidation here and then those mechanical buyers, price insensitive buyers start coming in and giving us a short covering rally. That is what we're going to talk about today. And Hans, I know you've done some work on this regard and I just talked about mechanical flows, but otherwise there really isn't anything calm in the macro event risk side. We have government shutdown potential. We had a cool CPI, which was what I was expecting. In other words, it's actually falling inflation versus rising. So we're kind of still in this deflationary impulse, equities as well. Jobless claims last week, not so bad. So we'll get another chance to look at those tomorrow morning, Thursday, jobless claims. And then, of course, next week, FOMC, not a lot is expected. Mostly Powell has one lever, which is the QT of the balance sheet, the Fed balance sheet, and whether or not they pause that to give the market some breathing room. Okay, 95% chance of no rate cut. We would really have to fall off the cliff, if you will, precipitously for them to pull forward a surprise 25, let alone 50. We're looking at that later on, but I think right now we don't have any policy intervention coming in, and that's the big thing, right? So if Trump was to come out and say, oh, I was just kidding about tariffs, Besant had some power, honestly, in Treasury general account and or ability to intervene. I think he would, but with the continuation, the reconciliation bill that's coming up and pushing the deficit not only to September, but the debt ceiling, I should say, but also this expansive deficit is just exactly what Biden ordered last year. So it doesn't help the market. And we've already started seeing money go home. The dollar is dropping. Again, that has definitely cliff dove, and it is for good reason. Re-rating of concentration risk, absolutely chaotic kind of political agenda. And then, of course, money's just going home. They're being incentivized to chase yields abroad, whether that be more Europe promises of stimulus or Japan higher yields. And of course, China is doing a lot to support their capital markets right now and their tech dominance run. So let's talk a little bit about the flows. Hans, what do you see?
Hey, Samantha. Hey, everybody. So yeah, coming from what I'd like to call the North Coast, or what you guys refer to as the 51st state in Canada here. So we'll have to see how that goes. I'm going to be running for governor of the 51st state, hopefully when that happens. So yeah, no, look, it's been interesting. Poor Joe Biden, he had 2 years of 20 plus gains and it wasn't enough to get him reelected. So here we are with you get what you get. And that is a whole bunch of bull in a China shop. China getting smashed around all over the place probably makes some people pine for the days of Joe Biden. So it is what it is. He's got this vision, and the vision it's fascinating to me. I almost feel like we're in a little bit of an experiment here, really something that on the one hand, he's kind of got this amazing vision and he sort of, he sort of harkens to the days of the 60s and the 50s and manufacturing and bringing back manufacturing and all the, the ability to own a house and a white picket fence and all that stuff. But we'll have to see how that turns out. But in the meantime, it has caused a lot of problems in markets. And I borrowed your quote several times over the last week, Samantha, just saying that light at the end of the tunnel, it's two kinds of light. I was sort of saying from a structural and derivative standpoint, we talked about the short Vega. Thank you that someone just said they'll vote for me. So there are some structural problems within the derivatives market. We talked about that short Gamma, short Vega. And so I said, well, and certainly technically some issues there. So I said, well, from a technical standpoint, from a structural standpoint, we've got some, light at the end of the tunnel because we've sort of had a big washout. The RSIs are way overbought if you put much into that. But from a longer term fundamental standpoint, the light at the end of the tunnel may be a freight train, as you said. And I think that's sort of the world that we're in, right? Where we hope, and I'm going to show you guys in a moment how there is a little bit of softening from the vol side of things in some respects, which can make us somewhat positive positive, maybe to be expected after such a very swift and vicious sell-off. I think the worst on the NASDAQ since 2022, I think it was. So we've had some very, very quick downward movement. A lot of people have been caught off guard and are having to deal with that, given the complete 180 that we've had from post-election, which was Trump's going to support markets and everything's going to be wonderful, to Trump is literally quite doing the opposite and saying we're going to toss Wall Street under the bus for Main Street, which Main Street's going to feel some pain as well. But this is the sort of mantra. Well, we're putting Main Street first. And so it remains to be seen if that kind of works out over time. But we are seeing a little bit of a softening of vol lately. I did notice this week we had a couple days there where the markets were down slightly. The VIX was down. And then again today, we see the VIX down quite a bit given the small rally. I think last I looked, we were up 30 or 40 points on the S&P. So we are seeing a little bit of a relaxation in fear levels. Remember that a VIX 27, 26, I haven't got my calculator handy, but we're probably pricing in about 1.7% of movement per day in the S&P. And that's quite a bit of movement. So if we have if we continue to have some days that are a little less breakneck, and I don't know if you noticed the ATR, Samantha, but the ATR was actually hit higher levels on the S&P, that average true range, than we saw in August. So August was that big swoosh down and all the way back. And if you didn't check your statement, you didn't even have to check your statement because it didn't matter. This could be something a little bit more durable versus that V recovery. Could be a little bit more of that rounding bottom recovery and hopefully not new lows. But this is a very different scenario. But we are seeing just a little dialing back, and we can talk about that in a moment.
So just to talk about your internal kind of volatility, I wrote about that. This is actually a really big deal. And we're not even going to talk about the Trump 1.0 versus 2.0 because everyone's firmly over that. But as it relates to inside the not only has the S&P retraced all the way back to the July highs, which was something that I was gunning for in a particular intermarket tell that I follow, and I'll show that in just a minute. But we're there. So we've actually gone through it, the July 16, 2004 highs. But and it's a lot of money, profit taking. There's a lot of money going home, leverage unwind, and there's still more to go. But for right now, I can see some examples of stabilization, and I have kind of gone through those and specifically shared those with clients. So I might as well kind of get you a little hit here, which is key levels in VIX, which I have identified very, very important levels in VIX. The dollar yen has to stop going down and move a little bit higher. 10-year yield also needed to stop going down and move a little bit higher. And yesterday we had a nice 2% reversal intraday, which was lovely. So, and then CPI, it came in cold. So we had a little bit of a boost there with sentiment. And we're definitely on some monthly support and value. It was absolutely trouncing gold. I mean, massively. In fact, we had a big divergence of 14% down in high beta. That's really large. And 1.4% for low beta, positive. So there's a real big divergence there. And this is to my big overarching, we don't have a great line in the sand yet as it relates to stability because we're right down into what's called a Fed liquidity pocket. We break through 5,600. This is the E-mini. We're actually going to pick up speed to the downside. So the fascinating point is when I posted this for clients yesterday, and this was taken on the 11th, I'm like, we're right at this level of bounce or trounce. So I don't think it's going to be the convexity rally that we had in August 5th and that triggered a short covering rally, but maybe we can get some stabilization and some reversal, like you said, in a bottom and before we start to roll over again, because there'll be another time to actually give up the ghost. But for right now, that's a key consideration. And a lot of folks might not do this, but I had warned in this spread, which was basically intonating back on the Tuesday, the 18th, that it was about to come out of this kind of diamond shape and dump. And we did. So all the way back through to monthly support at that kind of 5,500. It's a very big move. And yet we see nothing. I see nothing yet in any stabilization as it relates to buyers really coming in. That's what it looked like on the 19th, Wednesday, when I showed this here. And this is where we are all the way back down, well through the election and all the way to July. And I think for the most part, this is the reason why. We got a little bit of support yesterday and a growth bump, but value has still far outperformed momentum. And they're hoping right now that it's going to come in and momentum's going to get more than just a 1 day short covering, dead cat bounce. I'm very suspect.
You don't think that there's some reason to get a little bit excited about growth that has been trounced and people perhaps rotating a little bit back into those balance sheet heroes as a place of refuge almost? These are companies that are going to do well. Sure, they're spending beyond reason on CapEx probably, but these are very, very strong businesses. And if indeed this growth scare is in there, cyclicality aside, can these be a place for people to hide a little bit?
I don't think so, but it depends on everyone's time frame, right? So you're talking active investors versus maybe swing traders versus chasers that are obviously looking at every opportunity. I'm much more focused. My bread and butter is swing trading. So I'm looking for something that's going to be durable for a few weeks that turns into a few months, and trends that are a few months that turn into a few years. But I still run a live trading room. I'm still going to identify, right, what to look for traders that are also trying not to get shaken out of their hedges. So we kind of talked about this intraday volatility. Case in point, I was looking for the chart, but I couldn't find it right away. So I kind of, I filled the air, but this was the chart I was talking about. This is the intraday volatility starts from inside and then moves out. So this is just Monday, Tuesday. And look at the swaths of, ginormous, like you were talking about, the ATR, the average true range of an intraday chart is very large. And you know that I've also been, and I still am, bullish volatility for 2025. So it's not just intraday, but I think this year, and it isn't just because Trump is, chaotic in his on again, off again, on again, delayed, on again, off. The point is, it was time. We were just extraordinarily overvalued, and it was ready to obviously take some of the air out of the balloon. Now we have Trump, who really wants money to go home. He wants the dollar to fall. Basent, again, wants to backstop the bond market. So these are coordinated efforts to hopefully in time drive down the dollar, help the trade deficit in order for US exporters to get their, manufacturing back on shore, so supposedly, and drive this private engine growth mechanism. But that takes time. And he's not really, helping to coordinate that. In the meantime, market is very clear. Money's going home. The dollar is absolutely a mess, and it will continue to fall, by the way. It's not serving as a tailwind right now for equities, but it will for earnings for those companies that do derive a lot of revenue abroad. But this is backwardation, right? We didn't just fall in garden variety for a one and done like August 5th or like December 18th when we had a big, 3% down day. The whole curve is now in backwardation. So this is more
I'm
durable.
noticing that. Yeah, sorry, Samantha. I'm noticing that actually quite a few stocks. I'm looking at some of the even sort of 9-10 month vol having reset quite a bit higher, looking at something like the XLF in financials, for example. Really almost 52-week vol option pricing levels in those areas. So there is some evidence that there is almost there's a durable sort of feel to some of this volatility, as though the market's kind of digging in and going, okay, this is going to be a problem for a little while now. So that's going to make for some interesting opportunities on the Vega side of things, short Vega, taking advantage of a drop in volatility at some point. I don't think we're there yet. And I agree with you. I think any pullbacks, so there's always this sort of, one of my favorite sayings is low VIX can be expensive and high VIX can be cheap. And I think that we're probably in the latter for a little while now. So if we do see a pullback, we saw a nice pullback, starting to see the VIX, if you can chart the VIX, some people say you don't, but I certainly think you can. It starts to break down a little bit. Well, yeah, you like to as well, Samantha. I'm 100% in agreement that you can. And if we kind of come down below 24, we could revisit the low 20s. And then I think that's where things start to look a little bit interesting again as a rehook. So I'm almost wondering, and this is sort of my many-decade trader intuition, is that we get a little bit of good news that gets us one of those blow-ups towards the upside. Because when we talk about short gamma and short Vega and all these things, it can work to the upside as well. We've seen it work to the downside. We showed very clearly over the last couple of weeks that chart showing through 5,800, we've got some potential big problems. Boom, it happened. Sure enough, it played out. Now we're starting to see market makers maybe get a little bit more replenished down here. We're seeing CTA selling slow down, vol targeting. So the funds that need to sell when volatility rises and that need to buy the market when volatility drops, there's some good evidence that that is starting to slow down as well. So there's some evidence of support out there. We're seeing fixed strike vol come down, which is good. You don't want to see, when I start to see that fixed strike vol, basically those out of the money puts basically rising in a sort of more pronounced way than they should versus downside movement, then that makes me think that people are still offside. We're seeing the opposite of that. Things are starting to calm down within the structure of the VIX. Yeah, so here's where we are. This is your A to B, basically where we are living right now. The US economy today, and then where Trump wants us to be: smaller government, bigger manufacturing, lower imports, etc. And this is I've called it the Valley of Death. I borrowed that from an option strategy, from a backspread strategy where you get that valley. It's probably a little bit extreme in terms of the title, maybe more like a valley of uncertainty. So what we don't know is this part here. How much work is it going to be to get from A to B, if B is in fact even possible in the long run? So, that's basically what the market is dealing with. And a market, as I'm sure you'll agree, was kind of priced to perfection in many ways, with, record profit margins for years and years. This is what the market is having to deal with. It's not that the world is going to end. It's that markets, performance comes with the margin, as I always like to say. And at the margin, things have very, very much changed. But we're seeing this AUM in those leveraged ETFs. And remember, a lot of those leveraged ETFs are technology, Mag 7, semiconductors. So a lot of those kind of faster moving areas of the market, as that comes down, we start to see that there's a little bit less selling from those particular products. So
I have to show this real quick while you're talking about that. It's something I included literally last night with my market timing, with my market trading room notes. This is what you're talking about. These levered ETF rebalances are in the 1 percentile. They have sold a lot, is the translation. So
exactly.
This is a big point of saying, okay, so those, vol control, again, I've got another chart for this right here. Exactly what you're talking about. The systematic macro strategies of vol targeting, CTAs, risk parity, they have sold a lot. And that's what you're saying.
And that was, remember last week we showed this sort of, this chart that showed basically there was selling from many of those areas of the market in a down market, in an unchanged market, and in an up market. There was and we saw that every pop was met with a drop because there was just this massive supply of stock into the market. That is starting to calm down a bit. Now there's a little bit of a vol echo given what's just happened. So maybe there's a little trepidation in starting to move to the upside, but there is a potential. I feel there's the potential for a good 150 to 200 point move up at some point here. And that's where I was saying a little bit earlier, my intuition says we're going to get a little bit of good news that gets people back in and going, hey, things are starting to get okay again. And I worry that is then going to turn into a cascade that takes us down towards 5,000. That's just my little...
No, this is exactly what I wrote for clients. I said, okay, more intermediate term risk level, I have SPX 55.25. This is before, right? So we're already down in that neck of the woods. Anyway, for this leg, and then we have this kind of counter trend bounce, but I don't think it's going to be so meaty because there's no policy intervention that is expected to come in. Anyway, and the next thing I'm looking for is a major crash support level at 52.65. We're not there yet. We're still working out these mechanical flows. But I do have to put one thing in perspective, though. As bullish as it looks to have these levered ETFs exhausted from their selling, as bullish as it looks for the guy that I just talked about there, Marco Kolanovic, he's like, we should have a bounce soon. There is, on the other side, Morgan Stanley came out, their quant desk, putting out this unless so they're even hedging their bets, unless deceleration versus last week. It's still kind of chunky, but this is still pale compared to projections should leverage come down to levels we saw in 2022. That would lead to another 225 billion of supply from this group, talking about the CTAs, the vol strategies, the risk parity. Volatility controlled strategies would be the biggest sellers. You do have to kind of say, oh, it looks really good for a bounce, but then what happens after that?
Well, that's it. And everybody listening, just, no one knows exactly what's going to happen here, but that could be the big suck everybody in moment where we do get this little bit of a vacuum. And I'm going to show you guys, and we can see it here. We've got VIX Vega. So we can see the Vega, meaning this sort of tendency for things to panic to the upside in VIX and to the downside in the S&P. That's subsiding a little bit. We're having some of this negative, this accelerant, as I often call it, this sort of kindling that's sitting there ready to catch fire. higher. That is disappearing a little bit as compared to last week, moving on to this week. And as we go towards April, we start to get rid of that short put from the caller, right? The JPM, here we are again talking about the JPM caller. Isn't it amazing? We're talking about the call side up around 61, whatever it was, 50. Now we're sitting around the put side where there's that significant dealer short gamma.
55.65, isn't it? That part of that put spread. So we're right at it.
Yeah, you're right. 55.65, exactly. So it's amazing. JPM's really got it figured out. I know it's just sort of, there's no discretion there. It just, they do what they do, but it just so happens that we spent these, I don't know how many expiries in a row we've kind of spent around these important spots. Usually it's the call, right? Now we're actually sitting by the put. We haven't seen that one in a while.
That's the point. We had 2 years where NASDAQ doubled from January 2023 until the end of 2024. And they basically rolled into their upside sold call every single quarter. I don't think without exception. This is the first quarter they haven't. So we definitely have a big change as it relates to it.
It's a big change.
But I believe very, very firmly it's money going home. 17% of the US equities market is owned by foreign interests. And money is going home. They're incentivized to go home, period. So we definitely have more risk than reward on the upside. Although I know that's not where most analysts are still consensus bulls. Not one analyst has come in with a sell side, with the sell rating on NVIDIA, for example, despite DeepSeek coming in and deep sixing all of the semis. The semi sector has been atrocious. They're still not throwing in the towel. Not one has come in with a sell side, despite the fact that Microsoft is cutting this and competition with Quen from Baba or Manus is the newest one. So this whole AI euphoria that has hit data centers and power producers and software and hardware. Apple was supposed to be the golden child receiving all the benefits by not being a hardware company. Nope. They're right at that 220. Exactly. Right. So the point is I was re-rating these companies a month ago. We talked about this. Recession risk was not priced in. So now they're starting to say, maybe we should re-rate these earnings plays like Delta coming in and saying, oh, by the way, and then the airline sector just dumps, but it was already starting to. Or American coming in yesterday and saying 50% of our government contractors who travel often are gone. We literally just lost 50% of our huge base of business. So my point is they have not re-rated. The market re-rated before the analysts did. They'll catch down.
Yes.
Anyway, go ahead.
And that's what I'm talking about. The two kinds of light, the light at the end of the tunnel versus the oncoming freight train. We have this ability to kind of, for structurally, as we're talking about here, I'm showing VIX call skew coming off. So that broader market sort of relaxation, maybe unclenching of vol stress is kind of happening a little bit. But to your point about NVIDIA, I mean, the entire world got into NVIDIA. Everyone's into it. There was Torsten Slok who's talked about this massive leverage play on NVIDIA, everybody coming in from around the world having to have a piece of that. That is unwinding. And what's interesting is that the one point that I hear you making is that, listen, this is just starting from a reality standpoint. There is the market getting ahead of what's happening, and now we're pausing for a moment. But then there's the reality of, think of the headline risk that we have at this point. We just had Dick's Sporting Goods. We had a number of companies just come out and go, this is going to be not great. How many more of those are we going to get? So this is going to be our reality as traders, as investors, is every morning, how many companies are going to come out and go, we have completely changed our tune in terms of our outlook. Who was it the other day? They said, well, it was Yardeni. He said, in January, he was like, we're not going to have a recession for 10 years. Now he's like, we might be in one. And that's okay. I don't fault somebody for flipping. Good for him, because move your feet, change your mind. It's okay. Don't stick to your tune if you see things changing. But that is just one small example of things really, really changing out there. And my second point about this is that even though I'm seeing a relaxation in the broader market, a little bit of, from CTA, from vol targeting, from VIX, from skew, in single name, the skew is still very, very high. So I think there's still some risk. I'm going to hedge myself. I apologize in a moment, but there's still some risk because a lot of people have been sort of buying those out of money hedges in single names. And that still places a lot of pressure from a dealer standpoint to the downside, that negative gamma. But, and I think if we do get this bounce bounce of 100 to 200 points or whatever it is, I have no clue. You'll know better than me, Samantha. I think there could be an interesting play there in maybe doing a little bit of upside, maybe buying a call spread in some of these names. I think something like NVIDIA, I don't think I have the chart here, but I had a chart that shows the negative gamma to the upside on NVIDIA. So if it decides, if everyone just says, listen, we better go hide in growth stocks for a bit, and they've overdone it in value. I've been a big proponent of getting into those low vol stocks, but you can see some of those starting to keel over as well now. So if there's a little bit of a durable move back into growth, I think you could see a nice little run into growth fueled by negative gamma to the upside, which means there could be a little bit of an air pocket in something like NVIDIA and a couple of these other ones that have been trounced, like, I don't know, maybe a Microsoft. Maybe there's a beautiful play in there on a temporary basis, because I agree. I think we run into the wall of reality at some point here, where there is going to be nothing but negative headline, analysts re-rating. We know how the analysts are. There's going to be a lemming show at some point where it's going to be one after the other falling off a cliff going, oh, wait a minute, I better get on board here.
They're not willing to concede yet. They're not there yet. A 10% pullback is nothing. It's garden variety for most market practitioners. So they're not worried about this. They're still by the dip. But it is very interesting to have Citibank come out yesterday and say, we're going to downgrade US stocks and upgrade China stocks. And then today, JP Morgan came in this morning and said, we're going to downgrade US stocks and upgrade China stocks. They're a little late. China's already done a massive move. And we already had, SPY, of course, down 10%, Qs more. But now they're starting to look at this as it isn't going to be so easy to get economic growth with the current macro backdrop and with earnings as good as it gets, now going underneath, a little bit more suspect, kind of views. So anyway, this is definitely a time to be actively trading, actively protecting. It doesn't mean we're going to not have a fabulous bounce. I don't know, to be perfectly honest, until I can see my intermarket stuff turn, which is why I have been very persistent in this bearish view, because I have not seen the buyers step in. I have not seen they're hammering, puts, and in other words, they're selling puts and buying calls, where we had that really big convexity short covering rally on August 5th. We're not that situation now. I think we're going to have to base and have some macro trigger to get us going. And right now we have Besant saying no policy interference. In fact, we have to detox. Trump saying we should look at the market like the Chinese do, 100-year view. Point is, we don't have the same vibe that we had before of a nosy Fed, Treasury, and White House combined policy intervention narrative.
Nosy, right.
Very, very much in the business of the market to make sure nothing happened to get their guy or gal elected. That's off the table now. So I think it actually makes some sense. The market is orderly in its selling, and we can have these counter trend rallies. I don't even want to call them rallies. I'm going to call them bounces, because to me, a rally is we take out the highs. And the question in here is, are you still thinking of one more high, then we're done, or we're past that point now? The only way we're going to get one more high and we're done is if we get policy intervention. And right now, the policy intervention has been stimulus in Germany and Japan and China, but not here. So if the US changes its tune, Fed does cuts and halts its quantitative tightening of its balance sheet, that's a policy intervention. I don't know, honestly, what Trump and Besant can do, since they're right now embroiled in this, we must protect the bond market, and yet they're passing this ridiculous they're trying to anyway, this ridiculous budget. And that's a really good point. It's difficult to find anyone not looking for a bounce high, makes the Senate vote extremely risky for a flush lower into the weekend. Completely agree. And in fact, I think Trump is okay with that. Like I wrote about that a few weeks ago. I don't think he's even worried about if we shut down, if the government shuts down. They're in fact supposed to have announcements tomorrow. Again, I wrote about this weeks ago, where they're supposed to have, I don't want to call it mass government layoffs, but another big announcement on layoffs. So they're trying to cut costs, but they're not cutting spending. It's not going to work. The market is going to see right through that. Go ahead. Sorry.
Look at this. Elon's got to be licking his chops looking at this graph here. Government share of jobs added for government in the last 2 years. I mean, look at that. 2023, 2024. I mean, if you just unwind a good portion of that, and I sense that there's almost, what was I watching the other day? And they were booing the heck out of Elon. And I mean, he is a complete villain right now from a comic book. and he's out there with his chainsaw making light of, people losing their livelihoods. I mean, it's not very tasteful in some ways, but it's starting to wear on sentiment a little bit. And we're seeing that in sentiment from not just consumers, but from businesses. And that can really work its way in. I don't know what kind of policy intervention, but it better happen fast and it better be big, because it's working its way into the psyche of, of media and
also CFOs. I mean, just not for nothing, but look at the actual price action of these private equity firms. Like you're putting up Apollo, they're getting pummeled. So private equity right now isn't the golden child. NVIDIA isn't either. So this is what I mean by that kind of re-rating situation, where we need a complete turn and or policy intervention to create any type of momentum that can carry forward for more than a bounce. And I am still thinking that I got ripped off from my 272.46 SMH call. It came really close.
You were so patient with that. You held in there.
We hit 270, Hans. And then boom, right in the kisser. So anyway, I know trading isn't a game of perfect, but I was very patient. And then boom, DeepSeek came out and that was it.
You were close. You were close though. No, very, very close. Closer than I thought you'd be. So I have to hand it to you. Here's your bearish. Look at this AI. What's that? Sorry?
I said, but that's not the point. The point is, are we going to have a chance to go up and fill that gap? And that's what the question is. Do you think we're going to actually?
And that's the thing. We're getting so negative that would you put it past this market to have a massive face ripper rally here, where some of that negative gamma is going to start, and the leverage ETF, some of that's could work the other way to kind of suck people back in. But I think that could be a golden opportunity to at least get very, very big on hedges, a little larger than you would normally. We monetized a lot of VIX hedges this week. I left a couple on. I have a VIX 25, 30, 35 call fly that is sort of sitting right at the cusp of maybe being able to make money. But I feel like the VIX has got a good chance of kind of hanging in here. Of course, when you trade those products, you're not trading the VIX per se, you're trading the futures, but they're going to converge next week on expiry in the front part of the curve there. So it'll be interesting to see. But I have had some triple Q hedges paying to the downside, some 2x, 3x1. So playing with those kind of structures these days, a great way to play these moves, guys, is because volatility is so high. Those broken wing butterflies, those butterflies are a really, really nice way to have some directional delta, have a little bit of exposure to a move up or down, but everything's very expensive. So they kind of minimize your Greek exposure in a sense. You don't get, obviously, if you really have conviction that we're going to drop, you could buy some puts. And if you're right quickly, you're going to do fantastic and you get the full convexity. But if you're just kind of stick handling things back and forth, I really love those broken wing flies. Here's your bearish sentiment. So some conflicting data. I don't know what you'd think about this, Samantha, but we've got this AA bull and bear as low as we've seen it since the lows of 2022 in that sort of bear market year that we had. Yet at the same time, if you look at the percent of stocks above the 50-day moving average, we kind of still have a little bit of room to the downside. A lot of stocks have done okay, almost a little bit of, there's a little bit more room here to the downside. And the other one's sort of showing a very, maybe it's a little bit more sensitive to real-time data. I don't know.
So I spent 4 hours. This is my thing. This, like, what you're pointing to is what I exhaustively research, like exhaustively. So I have my set of intermarket tells and a bunch of, North American investor manager, active. Those are just some. And then I compare them to other periods. And I look at breadth, NYSE and NASDAQ and SPY and the whole thing. And then I look at everything, cumulative volume, the quant, the option market structure, et cetera. And then what, of course, the mechanical flows look like. I put that together. I spent all day, Saturday, probably 6 hours putting together a whole bunch of charts, because honestly, they only really say anything at inflection point. And then I put it together. I did a video going over all of these annotated charts. Point is, it still says volatility's not done. Now, I'm not talking about for a bounce. I'm not talking about like I set that up just the day before yesterday going, okay, here's what I'm looking for, a little bounce. And then yesterday, here's what I'm looking for, a cold CPI. So here's another little bounce. But that's just for a day. That's like an overnight boom. But big picture, I'm talking about, when is it safe to close hedges and buy again. That's what I look for, is that more durable swing long. And by the way, when we had the August 5th convexity rally, it was wow. It was huge. It was ginormous. There's nothing like it. It's VIX 65 pre-market, and then the buying just started and didn't stop. This is different. This is very broken. Underneath the market, we can have some nice little bounces, but we're in a huge topping pattern now. So at the time that happened in August, we were still trending up. So it was very easy for a convexity rally. Honestly, we also had FX currency as the trigger. FX was yen carry trade unwind, kind of see where positioning was for that particular asset. We have everything going on right now. We have the dollar dumping with a larger than 4 standard deviation move, which in the long term is exactly what the administration wants, but in the short term is extremely disruptive, and it's pushing foreign investors out. It's shaking up regular investors. There's a lot of volatility in a very short period of time, as you can see intraday I've shown, and as you have talked about, as far as this is historic. The point is, we're actually starting to roll over with the macro tailwinds to roll over, with the fundamental tailwinds to roll over. It used to be AI or quantum or whatever, and now that's going, well, actually China is eating our lunch, so we really have to be more realistic. So the point is, we have lost a lot of the story stocks. We have lost the macro tailwinds. We have a new administration that needs to do the, rip the Band-Aid off kind of thing and make it very painful to hopefully have pleasure later. So there is going to be these reflexive, not convexity, but I think more reflexive bounces into resistance. And we're going to have this process all Q2, unless we just dump down, and then really it's just way too yummy. But right now, buyers have stepped away. All of my intermarket analysis is still basing, which means it's oversold, which means buyers have not stepped in. They have stepped away.
Yes.
So until buyers actually step in and then we have follow through, there's nothing for me to get excited about. We could do this for another 6 weeks. We could go sideways for another 6 weeks, shimmy around that 200-day, which many people are all excited about. We're going to bounce to the 200-day. No. We can actually take that out and crash lower. Markets crash from oversold. Or we could go sideways for the next 6 weeks until we get another trigger, bullish or bearish. So it's all about time frames.
Well, then we really haven't had that big whoosh to the downside in vol markets. The VIX has been, I don't even think we hit 30. I think we hit kind of high 27s, 28. So if you kind of compare that to that ATR was higher than it was in August, but yet on the VIX side of things, which I'm a little surprised about, I have to admit, we've seen such a high beta of the VIX to S&P downside, and we saw that in August and September and December. It's rather been sort of orderly, especially considering the short positioning in those upside calls for dealers. So it's been a little bit on the kind of orderly side of things, even though it hasn't felt great for equity holders and certainly people in Momo and growth and NASDAQ. I almost wonder, I found this, there was this quote here that I saw somewhere. Is this what March, this is somebody on Twitter saying, is this what March 2020 felt like? Was it worse? I wasn't trading then. I wonder how much of traders who just kind of sort of live by this mantra of buy the effing, because it works every single time. And it really has, right? I mean, you have not been wrong in buying the dip for so very long. Potentially, especially in light of all the things you're talking about. This isn't coming from one angle. It's all angles of things being rather negative. Can the market run up 500? Sure, it's a market. It does what it does, but almost can't throw much more negativity at this particular situation. I think that's the weight of that reality that markets are having to deal with right now. I think a lot of people who've come into the market over the last few years just have no clue what kind of severe downturn this could very well become. So I hope I'm wrong, but really, I wonder, in your opinion, is it a fraying of American exceptionalism on the one hand because of that unraveling of the AI and, here comes China, here comes DeepSeek, here comes some of these other, maybe we can do things for less and for cheaper and more efficiently. And is it somewhat self-imposed deterioration of American exceptionalism because we're suddenly Trump is, for better or worse, or for whatever the long-term vision is he starting to destroy some of that himself, destroy relationships with other countries, which relationships are important. Globalization is a reality. So is it a bit of self-imposed reversal of exceptionalism as well as AI maybe not pulling back on that exceptionalism as well?
Yes, but let me first show you this chart, because we were really in the throes of North American active investors managing money, worried about these policies. They would be absolutely much further down in there, like you just showed the AA, the bears, whatever it is, that bear bond version. This is actually the one that shows they have not even come close to the August. So back in July and August, we were way down here. They were very quick to dump. We still haven't really sold off as far as investors are concerned. It may be, I don't even know why. They don't think it's a worry. We're still, American exceptionalism is the best, but we still have not even sold off in some of these indicators. Let me just kind of show you also when you were talking about breadth. This is S&P percentage of stocks above their 200-day. Back in August, when we had the yen carry trade unwind and NASDAQ fell 15%, semis fell 25%, NVIDIA fell 35%, we still did not pierce 65%. What are we right now? We're down in the 45 handle. Much worse breadth than we were after the yen carry trade. I could go on and show you that this is still a risk. One other thing that folks aren't really keyed in on is because credit spreads have been so tame, and that's one of the reasons why we have this outperformance until COVID. Speaking of COVID, for all of 19 and into and before COVID, credit spreads were also descending until COVID, and then obviously blew out. We have been in this very, very controlled downtrend as well for tight credit spreads. Credit leads equities. We don't need much as a trigger to actually get back above that trend line and push higher. So I still think the risk of a macro event risk is actually pretty evident. And to answer your question, the policies that are more macro driven as a way to decouple from the dependency on China, to decouple from the war machine that is really a lot of money laundering to Europe, although Trump is still very pro-war as it relates to Iran. So we're just trading one for another potentially. But the policies as it relates to getting manufacturing back to the US is going to be short-term, very destructive for our currency. And that's good as it relates to being able to have an advantage for US exporters, but it's very bad as it relates to the structure of the money that has flown into the US because of our strong dollar. So we're kind of trying to thread the needle of what is going to excite to keep money here. And right now they're disincentivizing. They're actually wanting money to go home. So less demand of US dollars. It doesn't mean we're going to dump precipitously, but I will warn, and something that Jeffrey has been on often, and this is our amazing classical economics advisor, Jeffrey Fourier, who is very much entrenched in what happens under fiscal dominance, what happens with trade deficits, what happens with these policies that are dollar bearish, oil bearish, yield bearish. The problem is, if they do not fix the deficit, we start to increase the rate of interest that is charged on our rising debt. We get another 2 basis points higher, let's say 6%, which is a Carson and some others have said we're going to 6%, we're going to 6%. That will destroy the US. It will destroy the US. You get 30% of interest on revenues and the currency will plummet. That's only at 6% for the 10-year. That's a big deal. The market's starting to kind of, hey, okay, money's going to go home. That's going to hopefully help exporters. That's not the point. If they don't get control of the deficit and this interest on revenues equals 30%, in other words, the 10-year yield goes from 4% to 5% to 6%, the currency in past has collapsed in other occasions over history. That has always been kind of the Bitcoin anti-American, hedge, if you will, right? They're worried about the devaluing dollar. By the way, Bitcoin will be also useless. Crypto will be gone. But the point is that is very much the focus of falling dollar is bullish until it's extremely bearish. And what happens also in the bond market is when the currency fails, US Treasuries are backstopping the value of the dollar. The dollar is used to pay the military, not Bitcoin. So the military is actually what has held our reserve status globally. Trump is trying to dismantle that as well on purposes of reducing war spending. That's actually very good. That actually can help deflate the inflationary impacts that we've had. But not if the deficit keeps rising. All bets are off. So the only way that we're going to save, we're going to be saved, is if in fact they get control of this fiscal spending, and specifically restructure, and specifically not just cut, out the Doge, the people that are in government, but the programs that are the Congress, the power of the pen needs to actually be controlled. Otherwise, all this talk that we have on a weekly basis about what stocks to trade, oh yeah, we're short this, we're long that, this is a great option structure. Honestly, none of it will matter because the dollar will fall with bonds. The treasury market will have a sovereign debt default, and that's within 200 basis points of where we are. That's what matters. So that's the macro. I don't worry about it. I run a live trading room. We got to chase what we have. We got to position what we see moving. But big picture, Trump is maybe, I don't think he's like keyed in on that, but maybe some of this stuff is great, but none of it matters unless we actually get Congress to reduce the fiscal spend. Full stop.
He's breaking a lot of eggs to make some sort of omelet. I don't know what kind of elaborate omelet it is, but I think in the long run, there's look, at this point, the market is in need of any kind of good news. Maybe it's going to be something from Ukraine. Maybe it's some sort of peace agreement that actually sticks. Maybe Powell comes out and says, yeah, we're going to start lowering rates. It's not going to happen right away, but at some point it will. And people will start to see a little bit more the actual light at the end of the tunnel as the freight train disappears. So I think that's the hope. And the question is, well, in that little valley of uncertainty, how deep do we get in this sell-off? And I agree. I think it could be sort of around. I was thinking that the lows of August sort of kind of make sense to me, even from a valuation standpoint. I don't know what would you want to put on there, 260, 265, for the S&P, for the SPY. I don't know where that needs to be, because the question now is going to be, well, where's the E? We can talk about PEs, but what's the E going to be? Nobody knows what the E is going to be because things are in complete disarray. There's a lot of what ifs, and of course, markets don't like that. So this is the world that we live in right now.
Well, I think that we have lots of opportunities still, but I do believe that maybe next time I will show you, because we'll be through the next week, which is the government shutdown. We'll have a decision on that, but some very large quarterly candles for anyone who is in technical analysis, because I love the macro. I love, comparing assets for that intermarket blend and then throwing it over to see what I can predict as it relates to movements, which has been very, very helpful in this pullback. Where is the bottom? And I don't see it yet. I don't mean short term, yesterday, today, tomorrow. I'm talking about next few months. Anyway, so the danger of having a bounce is that it gets firmly rejected and we keep rolling over, and the lows just make lower lows. And financials, a perfect example. We just took out massive amounts of profits from the past few months. We just took out all profits all the way back to July in the S&P. That's not a joke. That the charts are busted. They need time to base. They need a macro trigger to move higher. Full stop. I'll show you towards the end of the month my quarterly candles, which are also very bearish, but it doesn't mean we can't retrace half of that candle. It means that's literally a bullish backdrop for a bounce. It's high probability that we can bounce and then trounce in the next quarter and then continue in the next other half of the year. But no, I don't have a one more high and we're done unless we have massive policy intervention. And I think it's going to need to be more than just Fed QT, pause, and a few rate cuts. We already have 100 basis points priced in, 5,600. We already have 100 basis points priced in. That tells you how much she's going to have to cut still to make it even bounce worthy. Anyway, long story short, we'll revisit, actually, speaking of FOMC, next Wednesday after the close at 4 o'clock. Come on back. We'll interpret the Fed moves and the market moves and see if we've got some stabilization, because options expiration on Friday, which is March 21st, is a big one. And we also have Bank of Japan. I don't think they're going to hike this go round. But the point is, we do have enough data next week that we can kind of dig in. And right now, we're hoping to find a bottom and some stabilization so that we can bounce.
Yep. And in the meantime, if anyone's looking for hedges, just it could be as simple as, upside call spread, upside calls in the VIX. They're not cheap, but they could be more expensive. But if we get a little move back in the VIX towards 21.5, 21, I think, 18, 19 could be the new 12. I mean, we have got a floor in volatility for now. For all intents and purposes, there is no real reason I can see that things are going to really relax beyond below 19 or 18 or so. I think it's probably something that you want to keep looking at.
I have a similar read on the VIX. Right now, it really does feel like it wants to soften a little bit. I've got particular levels that I gave clients yesterday, but most importantly, I said, how the VIX cycle peaks, it was yesterday in the 10th, for the March expiry. So you will see this kind of gradual decrease in implied volatility moving into OPEX next week. So it doesn't have the energy unless we get a macro event, it doesn't have the same energy. But then after, we definitely can. And another thing for those who are looking for what triggers more selling, if the dollar yen drops below 147, it's no bueno. It's just no bueno. So a rising yen triggers this concentration risk de-risking. So please watch out for that. For those, I know everyone's on a different time frame, but I'm just saying I'm only getting into next week. And then the 10-year yield is critical. 10-year yield, if it continues to move up into 4.495%, that brings equities up with it. So we're reversed now. It's not when yields are falling that's bullish equities. You're going to have to work with me here. Just trust me on this. Right now, if we can get a bounce in dollar yen, we can get a bounce in the 10-year moving up into say 4.5%. That'll help pull equities with it. But then I expect them to roll back over again. So, and then of course I've got this, 5523 is monthly support, which is pretty darn close to what we hit yesterday. Wouldn't surprise me if we go back and tag it, by the way, perfectly, because you know me in those numbers. But then, again, if we break that level, it is a very decisive monthly level. We can go swoosh into an air pocket of risk down to about 52.5. So anyway, let's see what we get, but I think it's going to take a little bit more time and patience. And we'll be back here next Wednesday. We'll talk shop and answer your questions. Yes, bullish right now in the short term. I know it seems off, but it's working. Watch the 10-year yield. As long as this is supported, we don't go back and break down 4.2 and fall. If we fall below 4.2 again, we're at de-risking. We are in deflationary impulse. We are going to pull back down hard. So keep that on your radar. Those are 3 things hopefully to help. All right. Thanks everyone. Cheers. Bye.
Thanks guys. Thanks Samantha.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.